Hey everyone, and welcome to another episode of Retirement IQ, where I help you, our listeners, simplify the complex world of financial and retirement planning so that you can focus on building the kind of retirement lifestyle that you want to have. I'm your host, John Stregger, and today I want to talk to you about the 4 biggest mistakes we see people make with their tax-free savings accounts, which are also known as TFSAs. But before we jump into those mistakes, and to make sure that we're all on the same page, I just want to spend a couple of minutes covering off at a really high level what exactly is a TFSA and what are some of the key benefits to investing in those vehicles. So, what is a TFSA? Simply put, it's a type of investment account where any money you contribute can grow tax-free for life. You put in money that you've already paid tax on, after-tax dollars, and from that point forward, there's no tax on interest, no tax on dividends, no tax on capital gains, and no tax when you withdraw the money. Since you don't have to pay tax on your investment gains, your investment dollars can compound faster over time, which ultimately means more money for you. Now, since there's no taxation on withdrawals, from a retirement planning perspective, they can also be a great investment tool, as any withdrawal you make won't impact any income-tested benefit, such as old age security or guaranteed income supplement. Now, because TFSAs are so great for investors, CRA does limit how much you can invest or contribute to your account. TFSA contribution room is the maximum amount that you're allowed to contribute to all of your TFSAs without penalty. It increases every year and carries forward for life. Here are the key rules you need to know. First off, you begin building TFSA contribution room, the amount you can deposit into your TFSA, the year you turn age 18. After that, each calendar year, you can add a new amount to your contribution room. For example, in 2026, CRA allowed Canadians to contribute an additional $7,000 to their TFSA. Now, if you don't use your full contribution room this year, the unused amount carries forward to future years without expiry. Now, remember, it's really important that you do not contribute more than your available room. The CRA charges 1% per month on the excess until you remove it. We'll dig into that a little bit more later. Now, if you've never owned a TFSA and you were born prior to 1992, then your contribution limit could be as high as $109,000. Now, here are the 4 biggest mistakes that I see people making with their TFSA accounts. Mistake number 1, using your TFSA as a savings account and not as an investment account. Now, a lot of people have the understanding that a tax-free savings account is to be used strictly as a savings account. Often at the bank, we'll set up a savings account where we put extra money, whether that's for an emergency fund or just some extra cash flow for bigger purchases in the future. Oftentimes, people set up a TFSA just for that savings purposes without thinking of them as potential investment accounts. In fact, I believe that most people think that the TFSA is limited strictly to savings accounts because of the name, tax-free savings account. I think a lot of people would approach the product differently if the name were instead tax-free investment account. Using the word investment would trigger a lot more long-term bias to the product, which is how most people should approach it. So if you are in a situation where you have not maximized your TFSA limits and you have non-registered investments growing in a taxable environment, you should look at moving those investments into a TFSA to reduce your future taxes payable. Mistake number 2, choosing to invest in the TFSA over RRSPs for your retirement savings. Now, if you listen to episode number 9, which was titled, I Wish I'd Never Bought RRSPs, you'll know that we dispelled many myths surrounding high taxation of RRSPs at retirement. A lot of the time, people will tell us that they hate RSPs when they get to retirement because of the tax that they have to pay on that income. For some reason, when people go to withdraw the money for income, they forget about the massive tax break they received when they made the RRSP contribution. Sure, there will be a little bit of tax to pay when they withdraw, but for the majority of people, when they compare the tax payable at retirement to the RRSP income versus the tax saved when they made the contribution, the tax benefit is obvious. This is primarily true specifically if you are a high income earner. Most high earners we meet are destined to be in a lower tax bracket at retirement, which makes the case for RRSPs even stronger. Also, when you are strategic about your RRSP withdrawals at retirement, there are many ways to draw RRSP income out at a lower tax rate. First off, you have the ability to time your withdrawals in years when your taxable income is low. Secondly, if you're married or in a common law relationship, you have the ability after age 65 to split income with your spouse, which has the potential to reduce your taxes dramatically. So, when it comes to using the TFSA versus the RRSP for retirement savings, I would say that in most cases, the RRSP is going to be far more beneficial than the TFSA from an overall financial planning perspective. Mistake number 3, over-contributing to your TFSA. Now, this is a mistake that can cost you a lot of money in unnecessary penalty taxes. As we've already mentioned, CRA limits how much you can invest into your TFSA. So what happens if you exceed that limit? Let's look at an example. Say you come into some money through an inheritance or a lottery win and you had $119,000 to invest. You love the idea of tax-free investing, so you go and open a TFSA and invest the full $119,000 in your new account. Now, behind the scenes, CRA has a contribution limit on file for all Canadians. If you've never contributed to a TFSA and you're over the age of 35, then your limit is likely going to be $109,000. If we use that limit in this example, then you just over-contributed by $10,000. This over-contribution isn't likely to get noticed by CRA for many months, at which time they're going to send you a nasty little notice letting you know that you've over-contributed by $10,000. That notice will also tell you that the penalty for your over-contribution is 2% of the $10,000 per month that you over-contributed. That's $200 per month in penalties. So if you make this error early in the year, it's very possible to go 12 or more months before CRA lets you know about your little mistake. And that's going to cost you, 12 months times $200, that's $2,400 in penalties. How can you avoid this? We recommend to all of our clients that they open up an online account with CRA. This allows you to look up all things related to your tax situation. You can look up past tax returns, notice of assessments, RRSP contribution room, and yes, your TFSA contribution limit. You can also call CRA to get that information, but getting through to a live person these days, getting more and more difficult. The online account option is definitely the way to go. Now, once you have your limit information, we strongly recommend opening only one TFSA account. The number one reason people over-contribute to the TFSA is because they open multiple accounts and lose track of their contributions. On more than one occasion, we have had clients that have maxed out their TFSA accounts with us, inadvertently open up another TFSA, maybe at their bank on the suggestion of a teller, and deposit money into that account as well. When those people come back to us with their nasty little CRA notice, it's usually then that we've discovered that an error was made by a good intention mistake, but it was a costly one. Many of these over-contribution situations, they can be avoided by opening only one TFSA account or consolidating all of your TFSA accounts into one so that you or your advisor can help you keep things compliant. Mistake number 4, improper beneficiary designations. Now, one of the great things about the TFSA is that when we pass away, the money doesn't have to go into your estate to get to the people you love. So if it does go into your estate, then it has to go through probate. And in Ontario, you can expect probate fees to be about 1.5%. Furthermore, if the money does go into your estate, that money could be tied up and not passed on to your beneficiaries for anywhere from 6 months to 2 or more years, however long it takes to wind up an estate. All of that can be avoided with proper beneficiary designations made directly on your accounts. So let's look at the options. Firstly, if you are in a relationship, so you're married or common law, you can name what's called a successor holder. The successor holder, if you have that option, is definitely the way you want to go. Because what that does is if you pass away and your spouse is still living, then your spouse is able to roll over your entire tax-free savings account into their TFSA. This recently just happened to one of our clients, so we do see it happening. And to give you perspective, some of our married clients each have well over $100,000 in their TFSAs. If both of them have over $100,000 in their accounts and one of them passes away, their entire $100,000 will roll into their spouse's TFSA, and now that spouse will have a TFSA worth over $200,000. And there's no tax or probate fee to be paid on that transaction. So that's a great benefit. So what if you're not married or common law? In that case, you don't have that successor holder option, but you can name one or more beneficiaries, which is also great because your money is going to pass quickly to your beneficiary and avoid probate. Oftentimes, even within just a couple of weeks. Now, the difference here between the successor option is the money they receive, it's going to lose that tax-free savings status. But neither you, your estate, nor your beneficiary is going to have any tax or probate fees. So that's still a really great option. Now, the TFSA, it's one of the most simple and most powerful financial tools available in Canada. It can provide flexibility, tax-free growth, tax-free withdrawals, lots of investment choice, and no impact on your government benefits. Whether you're saving for a short-term goal or building long-term wealth, it's an account almost everyone can benefit from. Now, this concludes our 10th episode of Retirement IQ, and I hope you're really enjoying the show. I know we're having a lot of fun sharing our thoughts on everything retirement, and if you want to learn more, come visit us at freeretirementreport.ca. We'd love to hear from you. Until we meet again, I'm John Stregger, and thank you for listening to Retirement IQ. Have a great day, everyone.
The information provided in this podcast is general in nature and should not be relied upon as a substitute for advice in any specific situation. For specific situations, advice should be obtained from the appropriate legal, accounting, tax, or other professional advisors.